Hello, everyone, and welcome to today's webinar, Year-End Tax Strategies. This webinar is presented by Nick Romanelli and Brad Botcher, principals at CLA. My name is Megan Furl, Education Events Coordinator here at IFAI, and I'll be helping to moderate today's webinar. A couple housekeeping notes before we get started. Today's webinar, you will have the opportunity to submit comments or questions to Nick and Brad by typing them into the questions box on your control panel. You can send in your questions at any point during today's webinar and we will address them at the end. You'll find today's presentation in the handouts tab of your control panel. Feel free to download it and follow along or have it with you after the webinar. And today's webinar will be recorded, so you'll receive an email from GoToWebinar tomorrow with that recording. Otherwise, I would now like to pass things off to Nick and Brad to get started.
Thanks, Megan. And thanks everyone for attending today. So normally in a year-end tax planning session, we would have a little bit more routine content here. But I want to kind of go back and give some context on why this year is a little bit more challenging. So since Biden took office back in January of 2021, there's been a lot of talk about tax changes and tax proposals. A lot to pay for some of the COVID-related relief that has been handed out over the last few years. And we haven't got much in the way of tax reform at this point. They just passed the infrastructure bill back in early November, but that bill didn't have a lot of tax proposals in there. It was really just focused on cryptocurrency and the elimination of the employee retention credit in the fourth quarter. What we have now is a bill that is in process that does contain a lot of the tax changes. And there's been a lot of differences, or there will be a lot of differences in the plan here than where Biden started out with. He started out talking about capital gains rates going up to 40% and a lot of other changes that caused some people maybe to react or maybe plan a little bit differently than they would. A lot of that stuff didn't make its way into the final proposed bill here, and we'll talk about that in a second. But the current bill is called the Build Back Better bill, and it passed the House back on November 19th, which we knew was going to happen. And it's currently sitting in the Senate for deliberations. And the interesting thing, the process that the Democrats are going through to pass legislation through the reconciliation process requires all 50 Democratic votes in order to move forward. And there have been two senators, Manchin and Sinema, that have been objecting to certain proposals in the bill and have said they're not going to sign it. I think I heard yesterday that Sinema is now more on board, but still Manchin, the Democratic senator out of West Virginia, is in no rush to sign this and is kind of holding up the whole process. So they're continuing to talk and have deliberations. My guess is that if the Senate does end up passing a bill, it won't be the current bill. There will be some changes and some adjustments. And so what we're dealing with here for tax planning is some uncertainty on what the rules are going to be going forward. And so one, whether or not we're actually going to pass a bill here, are we going to have any changes or not? What's that final bill going to look like? What are the detailed proposals that'll be in there and when it'll be effective? I know there's been a lot of talk on retroactive effectiveness. They threw in a September 13th date at one point in time. We don't know where all of that's going to shake out. It's looking more likely that it'll be 1/1/22 or forward and not have any sort of retroactive impact. But again, we'll have to see. So moving on here, what's out? What is not included in the current bill? And a lot of this stuff is where some of the big opposition came from. So looking at corporate tax rates, they really didn't change corporate tax rates all that much. Current rate is 21%. The proposal here has some brackets, but you'll see you're going to stay at 21% or even a little bit lower until you get to $5 million of taxable income. So even for a lot of C corps, they're not going to have any tax rate changes if they're under that $5 million of taxable income number. Individual tax rates, capital gain tax rates, the max rates didn't change. So we still have a top rate of 37%. We've got a top capital gain rate of 20%. Now, there are some surtaxes potentially that could artificially increase your tax rate, but there are some income thresholds on those as well. So again, if you're not over those income thresholds, your tax rate may stay the same. They also talked about phasing out Section 199A, and Section 199A is specific to pass-through entities, S corps and partnerships that operate in certain industries, and it basically allows a 20% deduction against that type of income, basically dropping your tax rate from 37% down to 29.6%. There was some talk of having that deduction phase out over certain income levels. That didn't happen. It also talked about the estate and trust rules. The exemptions, the lifetime exemptions right now are historically high. They're 11.6 or 11.7 million per person on a married joint return. So you've got a lot of value that you can transfer without being subject to estate tax today. The initial plan was to drastically drop those exemptions down to $3 million. So you're losing almost 17, $18 million of wealth transfer there. None of that stuff ended up making it into the Build Back Better plan. They also talked about carried interest with specific to private equity and changing some of the holding period requirements before you can avail yourself to the capital gain beneficial rate. They wanted to move the holding period requirement today is 3 years. They wanted to move it to 5 or 6. That didn't happen either. So we've got kind of a lot of projection from Biden over the course of his presidency so far, really trying to maximize tax rates and really push that needle. A lot of that stuff didn't fall into this final bill. Now, talking about what's out, let's switch to talking about what's in. I'll let Brad take over and talk about some of the individual provisions in the Build Back Better proposal.
Yeah, thanks a lot, Nick. You know, the one piece that I'll chime in quick with that is, so we really don't know. This is what's in there currently. At this point, you know, with what we're hearing, it's likely going to be well after the first of the year before anything happens. Really, for anything to happen before the end of the year, it's basically has to happen this week, and it's not going to happen, unfortunately. So a lot of this is conjecture. There will be changes to some of this, but we just want to run through really kind of quickly on this piece of what's in there, so it gives some feel of what at least the spirit may end up being. So one of the first items on there that we have on this is the extension of the child tax credit. So historically, and this isn't new for 2021 or going forward, we've had this for 2021, but historically for each child under 18, there was a $1,000 tax credit. That was, you know, enhanced quite a bit, so that now, and that's going to continue with this plan. So it'd be $3,600 for children under age 6, $3,000 for any child under age 18. So that piece would really be extended and continue forward into this plan. One of the bigger ones, and ones that's probably the most likely to change, is what we call the SALT cap. So right now under current law, taxpayers aren't allowed to deduct any more than $10,000 of state and local taxes, so like your income taxes that you may pay to your resident state, real estate taxes, registration tabs on your vehicles, for a few examples, some of the main ones. That limits $10,000, and under the plan, that would be increased to $80,000. We're going through the committees right now in the Senate. This is one that is very likely to change, and right now the discussion is actually removing that cap altogether for a few years and allowing taxpayers to deduct really whatever they're paying in state and local taxes. For some high net worth people, those can be some very, very significant numbers. So this one's one that a lot of people are keeping an eye on. Cryptocurrency, you know, Nick mentioned that a little bit, that some more regulations being put in, with one of the bigger ones being what's called the wash sale. So right now with cryptocurrency, as we see lots of fluctuations in the value, if we see, you know, you buy Ethereum as an example, if we see that dip down, the strategy is, okay, well, I'll sell this and then buy it right back. Well, I sell it, recognize that loss, and I can deduct that on my taxes. Well, the wash sale rules, those currently apply to stocks and mutual funds as an example. What the wash sale rules say, well, that's fine, you can sell it, but you aren't able to deduct that loss unless you don't buy it back for at least 30 days. So for cryptocurrency as an example, when we see lots of very, very fast fluctuations, that's going to really disallow a significant portion of you know, of the losses that would be resulting from the cryptocurrency investments. So really what we'd see from that piece is it kind of gets rid of that speculative piece of, if you want to get out of it, it's really an investment decision and you're going to stay out of that. I would say probably the biggest impact that we're seeing, at least in our client base, which tends to be a lot on the business owner side, is this expansion of the net investment income tax. So that piece is right now it's an additional tax that's placed on investment income. So we see that in interest, dividends, capital gains, and what we call passive investments. Basically, I put my money in. If I get money back on whatever business I may invest in, I'm not actively involved in managing and running that business. Those types of investments are subject to this additional tax. Under the Build Back Better plan, there's a provision in there that would say, well, for any income for taxpayers with over 400,000 if they're single or 500,000 if they're married, if your income's over 500,000, all of your investment income, which is the biggest piece of that, is going to include your a business you're actively involved in, you're going to be subject to this additional surtax as well, which having that apply to all of essentially many and most businesses and business owners, especially the ones with higher income and success, that is a significant increase.
Yeah, and this is specific to flow-through entities that we're talking about. So S corps and partnerships. And so this, while the income tax rate didn't change, you might have some additional tax costs because now some additional income that you have is going to get hit with this net investment income tax. And so we'll talk about a little bit later about the entity selection analysis, whether you want to be a C corp, a partnership, an S corp. Now, when you're making that decision in an S corp and a partnership scenario, you've got to factor in that additional 3.8% tax.
Absolutely. Thanks for that. Appreciate the clarification on there, Nick. And the last place we've got in this slide is it's not a tax. I mean, from the state of Minnesota, historically we've heard that we don't have tax increases, but we have increases on fees and surcharges that somehow that makes it sound different. But so this is not a tax increase, but it's a surcharge where anyone who makes over $10 million would be subject to an additional 5% surcharge on whatever income they would have. If you get over 25 million, it goes from 5, it's an additional 3%, so it'd be another 8% income that we would see, or excuse me, 8% surcharge that we would see on any income in excess of 25 million. I think you might hit the next slide. All right. Then the last pieces that we kind of see on the individual side, not so much on the tax structure, but just more some of the really strategies that we'll talk about a little bit later in this presentation that we utilize, that we're seeing some more limitations being put on those. So one of them is the IRA limitation. So whether it's a Roth IRA or a traditional IRA, that's a mechanism that we typically use to either reduce taxes currently or reduce taxes in the future by putting assets into these IRAs to kind of shelter them from income tax consequences. Well, there's a limitation we put on there. It wouldn't start until 2029, so it's still quite a ways out there. So it's very possible that this would never actually come to fruition, as with, that's so far out there that we're likely to see an administration change of some kind by then. That anybody who has more than $10 million in an IRA would not be allowed to contribute any more into it. So basically, it's going to be fixed that we can't continue to allow these to grow and expand and shelter income for extended periods of time. Along with that, one of the strategies that we'll talk about in a little bit is what we call the Roth IRA conversions. So with the Roth IRA, you don't pay tax when the money comes out. The downside is we also don't take a tax deduction when the money gets put into it. So one of the strategies that we use is we take a traditional IRA, which when that money comes out, we do pay tax on. But if we can control the timing on when that comes in, maybe we have a year where we have a lower taxable income. Well, or if we feel like we're gonna have higher tax rates in the future, we bring that income in this year, pay our taxes at 10, 12, 20%, and avoid paying tax on that later at whatever the tax rates would be. So that's one of the strategies that we use to really kind of try to shelter some wealth inside of these IRAs. Well, if anybody makes, so it's 400,000 for single, 450 for married, anybody who makes over those income thresholds will be ineligible to participate in that.
Yeah,
really,
and those Roth conversions.
Go ahead. But so really on those, at those income levels, it's not really a huge deal, because at that income level, we're not usually, barring extenuating circumstances, we're not usually looking at doing Roth conversions at that income level because their income's too high and the rates get higher. But it just puts another restriction on there as to what we kind of see some of the intent being with some of these restrictions. Go ahead, Nick.
Yeah, I was going to say, I think in a certain category of people kind of in that higher net worth, we have seen some of the Roth conversions be popular because they've got enough liquid cash to pay the tax from outside of the plan, meaning they don't have to take any money out of the plan to pay the tax on the conversion. And we've got historically low tax rates. And really, you're just playing an arbitrage between your tax rate today and your tax rate in the future. And if you think your tax rate is going to be higher in the future, then a Roth IRA is a great opportunity. If you think your tax rate's higher today and it's not going to be as high in the future, a traditional IRA makes sense. And so we have seen a lot of that with the tax rates today. And so that opportunity could be closing here December 31st of 2021.
Yeah, that's a good point. Particularly with our high net worth clients, as we looked at some of those surcharges of over $10 and $25 million, well, if we can convert that this year before those surcharges come into effect, that's a 5 or 8%, rate pickup basically just right there alone, if we have the opportunity to stay under the limits.
And this is going to be one where you've got to do something by December 31st. So this uncertainty and not really knowing what the rules are going to be, it's going to be tough to kind of make that decision. The good thing is it doesn't take very long if you wanted to convert. Usually your investment advisor can do that in a few days. But we might not have an answer on whether this is a viable strategy anymore in the future until subsequent to year end.
Right. Then the last couple items on here is really expanding a little bit more on some pieces that were originally in some proposals that were a little more contentious, just from it had a higher profile in the general public. So I just wanted to touch on those quick. One is the basis step up. So when a taxpayer passes away, there may be estate tax consequences, but whatever beneficiary inherits it, they take the new value at whatever that asset is worth. So, I'm a very generous guy. I pass away. I leave $1 million to Nick of, let's say it's some investment that I have. Nick, if he decides to sell that, he pays tax on whatever it is over that $1 million that he inherited it at. So it's a pretty significant benefit to the beneficiary, so they don't have to pay the taxes from whoever they had inherited it from. There was talk of putting some limitations on there. That's currently been off the table. The other big one was what's called a 1031 exchanges, where if you have real estate, you sell it. As long as you reinvest those proceeds into another piece of real estate, you can avoid income tax. So when we look at real estate developers or really anybody who wants to invest in real estate, it's a great way to get out of a property that may have a very high value that you think is probably at the peak of its value. Get out of that and get into another property at a very tax-friendly way. There was discussion on that of eliminating that piece. That fortunately is also off the table on there as well. And we did talk about income tax brackets as well, so those haven't changed at all either. Last piece that I've got, and then I'll let Nick talk about the business part. We're talking about both of these surcharges and the net investment income tax and how that applies to individuals. Similar concepts with trusts. A lot of trust rules tend to follow what individuals are. The downside is trusts tend to be more easily impacted. So while the net investment income tax, that part there's no limitation on there. Any trust at any income level is going to be subject to this net investment income tax on their trade or business income. So that's a new piece where right now, if they were active or the grantor is active in the business, you can exclude that from that investment income tax. Wouldn't be able to do that going forward. The other piece is the high income surcharge. That was a part where for individuals, if you're over 10 million of income, then this 5% would kick in. Well, for trusts, it's a much lower threshold. It's only 200,000 of income. So it's a piece where it's the same rules as what we see in the individual side, but it affects everybody at a lot lower rate. So that's the biggest part that we see kind of the trust pieces. This is something that would affect a lot more on the trust side due to the lower income thresholds.
Yeah, and we're not going to talk a lot about trust planning when we get to the planning part of it, but one opportunity here is there's a mechanism, depending on the type of trust, where if cash gets distributed out to the beneficiary, basically all of the income outside of capital gains will also shift from being taxed at the trust level to being taxed at the individual beneficiary level. And so the strategy is, instead of leaving all of that cash and investment income to be subject to potentially some of those surcharges at very low thresholds, is you distribute the cash along with the income tax impact out to the individuals who we know don't have that surcharge until 10 million and 25 million. So you got a lot more room there on the individual side than you do on the trusts. And this chart here, I think just talks through some of the highest tax rates on capital gains if this plan were to go through. And it might be a little tough to see on my screen here, but I think the average is around 37. And then you see certain states, look at California, which is the highest tax state, and that's 20% plus the 3.8% net investment income tax, plus California's 13.3% state level tax, and then potentially adding in the 5 and the 3% surcharges. So that rate starts to build up pretty quick, especially when you get into those high income numbers. So that's kind of the overview of what's in the Build Back Better proposal, at least from an individual standpoint. So moving to the business side, and we touched a little bit on the first one there, C Corp tax rates didn't move substantially. Again, up till about $5 million, you'll avail yourself to a little bit of an 18% bracket. Otherwise, you're in the same 21% bracket that you would have been in 2021. If you do have a very profitable C Corp over that 5 million, you can get into a little bit higher tax, and you do lose some of the graduated rates when you get over $10 million of taxable income. The other big one is on research and development expenses. Currently, the rules are that as you incur those expenses, you can deduct them. That actually sunsets. So this was something that has kind of continued to get extended, and it was set to sunset. And in 2022, you were going to have to start capitalizing those R&D expenses and amortizing them over, I think it's a 5-year period. So you don't get the same benefit of taking the deduction all in year one. Well, the Build Back Better plan would eliminate that required capitalization, put it back to kind of what we've had historically, where you're expensing R&D costs as incurred. The next one is specific to non-corporate taxpayers, and this was part of Trump's legislation back in 2018, and so we've had this around for a few years, but because of COVID, they actually suspended it or delayed the impact for 2020. And so we've got a little bit of a unique thing where all this is kind of going back to what the rules would have been otherwise if we didn't have COVID, with one significant change. And so what the excess business loss rules say is that if you have a partnership or an S Corp or a sole proprietorship, you can only take up to $262,000 of loss from that entity on a single return, or $520,000 on a joint return. So for example, if I had an S Corp and I had $1 million loss, that $1 million loss would be limited to that $524,000, and the excess would carry forward as a loss that I can use in the future. The old rule, and the rule that will kind of reset for 2021 actually, is that in the subsequent year, so I've got my $500,000 limitation in year one, 524. If anything rolls forward, the rules were that it converted to a net operating loss. And a net operating loss would be available to offset any other income that you have on your tax return, not just specific income from that pass-through. The change is that instead of the carryover now being treated as a net operating loss, being able to offset all other income, the Build Back Better plan is saying that loss is specific to that activity. So it rolls forward, and it's as if that entity incurred that carryover loss in the subsequent year, and again, subjects it to the same $524,000 limitation. So it's basically only allowing you to offset that loss against current year income from that pass-through, or if it doesn't have any, the max you're getting is $524 a year. So if you had a year where maybe you had a lot of bonus depreciation and you had a $5-6 million NOL, it might take you a little bit of time to be able to monetize that NOL and offset some of those other income items. The next one is more on publicly traded companies and some surtax on stock buybacks. And then the last one here, this is one that I'm not sure is going to make it into the final provision. It also probably won't impact anyone on this call because it's more geared towards publicly traded companies or extremely large private companies with the excess of $10 billion of assets. And basically what it's saying is there is a US minimum tax on book income that's reported on a publicly traded company's filings with the SEC. So for example, Amazon, and this is kind of the Amazon rule, they actually named it that. Amazon on their financial statement showed a profit, showed a financial statement profit, but because of some of the way that they're structured for tax purposes, didn't pay any tax and probably showed losses. And what this rule would say is that I don't care what you did for tax purposes, you showed book income, now you have a floor on the tax that you have to pay in the US. I don't think this is going to pass just because book income is a very subjective category, right? Some companies are required to use a certain accounting method standard versus another, and there's some room for interpretation and there's materiality impacts that could adjust that book income up or down. And so I don't know if the IRS wants to pin themselves to someone's audited financial statement and the GAAP rules in this scenario. So my guess is that this one will come out, but it is in the current proposal.
Yeah, the other part that's very controversial with that piece is that by having that in there, you know, the U.S. already has a relatively aggressive, tax system that just makes it that much more of a challenging system to navigate. And the fear is then, well, it's going to further disincentivize people to invest in the U.S. economy and in creating jobs and having businesses here. So there is a lot of pushback on that piece just from the political side of what would the impact of that be as well.
Yeah. The Build Back Better plan also has some international stuff in there. I'm not going to spend a ton of time. The gist is that there'll be some slight tax rate increases. It's potential for the way that you compute your foreign tax credits to change. That the Build Back Better plan talks about looking at it on a country by country basis. So if you have currently today, if you had taxes paid in China and in the UK, you can kind of bunch those together and smooth your rate out a little bit. Now what they're saying is you've got to look at it specific to China and specific to the UK, and you can't combine them anymore. So there could be some changes in the mechanics there. But again, we won't spend a lot of time on here. If you do have international operations and want to reach out separately to have a more detailed conversation, be happy to do that. So that's kind of what's in the plan. And so the next step is trying to figure out what do I do? What does this mean for me? And so we'll start on the individual side. And again, just caveating it that we don't know exactly what the final rules are going to be. But that doesn't mean that we can't still look at what we think our income levels today are going to be in 2022, maybe in 2023, and start to see how some of these proposals might impact us if it does get passed.
Yeah, so some of the concepts really that we kind of look at when we do the tax planning. I mean, the first place that I guess when I do planning, and then Nick, I'm sure it's the same for you, is what we look at is what do we think things are going to look like going forward? Because if you're going to be effective in planning, it's not just about minimizing taxes today, it's about minimizing taxes over the long term. So the first part we look at is having that discussion of, well, what does this look like? Where do we think things are going from here? So we can try to position ourselves, in the best way. And really that dovetails right into, essentially it's the timing. And this will, Nick will talk about this as well on the business side, is we try to time when we have those income expenses. So, we want to match higher amounts of expenses when we have higher amounts of income, to try to balance that out. So a couple of the pieces we have in here, like capital loss harvesting is a great one. If we have significant capital gains, let's say that our cryptocurrency has done very, very well. Well, if we have some, like we've seen the last few weeks, if we see a dip in the market, and maybe we harvest some of those losses. Maybe we've got a couple of stocks that are not performing as well. We sell those, and we can turn around. We can just, if we want to keep the investment, maybe we buy a similar company in a similar industry, so our portfolio stays balanced, but we have that loss to try to offset the higher capital gains pieces that we have. We talked
And
about this.
on the capital gains piece too, just to be kind of clear here, so capital losses can only offset capital gain. Outside of that, you can only deduct a net $3,000 of capital loss in a given year. So the other thing, as Brad talked about, is making sure that in the year that you're planning on triggering a loss, that you have gain, right? A lot of times we might, let's say we have a capital gain that came in 2021, maybe on the sale of a business, and we thought the capital gains rates were going to go up next year, and we had a capital loss carryover. We could have triggered another capital loss in 2021, but because of the rate increase, we decided, all right, I'll just pay the tax on the capital gain in 2021, and I'll use that loss in 2022 to offset higher taxed capital gain. Well, you better make sure that you have that capital gain in 2022, because in that scenario, if you've recognized the capital gain in 2021, and then you trigger the loss in 22, but you don't have any other gain to offset, you can't carry that loss back. You can only carry it forward. And so when you're timing those losses, just make sure that you've got a gain triggering event that you're going to be able to utilize if you're going to defer recognizing some of those losses.
Yeah, appreciate that. Then, you know, the one that I look at charitable contributions a lot, because it's an, you know, people are, one, they're charitable, but two, there's some easy ways to get some easy deductions, especially on the individual side. So, you know, most people think of, okay, donations, I write a check to my local, you know, charitable organization. That's great. There's nothing wrong with that. But there are some non-cash options that can be very, very lucrative. So the easiest one, it's the one that I always look at and I say, well, it's essentially free deductions, which is just get rid of the stuff that's in your house. The clothing, the household items, like you already paid for it, you don't use it. One, you get rid of it because, you know, I've got 2 young kids and I need to make room because Christmas is coming up and I'm not quite sure everything's gonna go. So I always make them clean stuff out, make room. We get, basically you can take a tax deduction for that stuff. You know, give it to your, you know, Salvation Army, Goodwill, any of those thrift store type of organizations. And whatever they're gonna sell it for is what we're allowed to take a tax deduction for. And in most cases, what I've seen, it ends up being higher values than what people think. If you look at, you know, like Goodwill's website or Salvation Army, they do a great job. They'll, you know, most of them will have guides right on their website that say, here, this is on average what we sell a men's shirt for, as an example, or kids' toys, to help frame that piece. So you can, you know, try to establish those values, and it ends up adding up a lot quicker than you think. So that's one of the pieces I always encourage people to do that they don't think of. The other big one is on the non-cash side is, you know, we talked a lot about, you know, investments with capital gains. So let's say that I've got, you know, General Motors stock and I bought it a long time ago. It's worth, you know, a fair amount of money. I've got a big gain on it. Well, if I sell that stock, I have to pay the taxes on whatever it's worth versus whatever I paid for it. I have to pay that differential in taxes. Unless if I'm charitable and I'm going to give money to a local charity anyway, maybe I give them some of that stock. By doing that, I don't pay the gains on that because I just gave it to the charity, but I can still take a deduction at whatever that stock is valued at the time. So it's a nice way, it's an effective way that if I'm just going to give somebody, you know, cash anyway or some of my funds, if I've got, you know, some investments that ultimately at some point I'm going to sell, right? Well, I'll just keep my cash. It's just effectively like I just sold it myself, but I'll keep the cash and I'll just give the stock to the charity. And it's a nice way to effectively kind of transition some of those funds in a tax-friendly manner to a charity.
Yeah, the only caveat there is you got to make sure that it's long-term stock that you've held for over a year. Because if it's short-term stock, the rules are your deduction is limited to the lesser of fair value or cost basis. And so in that scenario, you would be getting your deduction at cost basis, not the fair value if it was short-term. So make sure it's long-term stock that you're going.
Cryptocurrency, not a great idea for this one. Then the last piece on it we touched on it a little bit was really kind of the retirement plan piece. This is always a nice one, you know, the contributions to retirement plans or to IRAs, because it's one that you can do after the end of the year. So you have until April 15th that if you want to put money, if you're eligible, we can put money into a traditional IRA, we can take a tax deduction for it. Roth IRA, we can put money in there. Downside, we don't get tax deduction for it, but we also never pay tax on that money once we take it out, as long as it's in retirement. The other piece that I'll say with the Roth IRA that's nice is once you've established a Roth IRA for 5 years, you can take your principal out tax-free. You can't take the earnings, so whatever growth you have has to stay there without being penalized until you get to retirement. But you could take your investment back out if there's a reason that you need some cash flow needs. So that's a nice piece that offers some flexibility that if, as we saw it happen a fair amount in COVID, that, people are unemployed or, had a reduction in hours, it was a nice way that, well, I can get to some funds if I really need to. And we talked a bit already about the Roth conversion, so I'm not going to touch on that part. And I'll run through these last ones. Some of these are relatively narrow, so I'll run through them pretty quickly. The qualified opportunity zone, that's a fairly complicated area that, I'll be honest, we could spend an hour talking on just this piece. So I'm just going to talk really quickly at a high level part, which is if we have a capital gain of any kind. So if we have a capital gain, we can reinvest that gain into what's called an opportunity zone fund. So it's basically an investment in a distressed area. And there's lots of definition of what a distressed area is, but what it tends to be is downtown areas. So not necessarily distressed from a commercial standpoint, but it's really more from an income standpoint of the people that are living there. So when we invest in an opportunity zone, there's two significant benefits. One is that we can defer paying tax on that gain till, I believe it's 2026, if I remember right.
Yep.
The big incentive is if we leave that investment there for 10 years, whatever profit we have on that, we never pay tax on. So that's the big piece. We got to make sure we hold it for 10 years. That's a crucial part. So this isn't something that we're going to look to flip in the next few years. It's really something with a long-term play in mind. But there is a significant benefit for it, and tends to be in a lot of areas that you don't expect. I mean, it really covers a lot more areas than you would think. We talked a little bit about the estate side. Not a whole lot of changes right now under this plan. That could change. 529 plans. Basically, this is a good investment that you can set money aside for your kids or grandkids. Really set aside money for college. There are some different state incentives. Some allow deductions for it, some don't. But whatever money you put into these 529 plans, whatever it grows, as long as the money is taken out for college, there's no taxes. There's no tax paid on that piece. And if you have a kid that doesn't need the funds, we can also change the beneficiary at another time as well if we find out that, hey, Johnny doesn't need as much funding as another kid, so we can change the beneficiaries in that piece to allow this to be utilized. Last one is the 1202 stock. Pretty narrow part on this, but essentially, if for small businesses or smaller corporations that are set up that are organized as C corporations, when they sell, there are some tax incentives where a portion of the gain can be excluded. That limit would decrease from 100% of it being excluded down to 75 or 50%, depending on where the income falls.
Yeah, and this can be a powerful tool, and maybe that's a good transition into kind of the first topic on the business tax planning piece. And we'll start with kind of reviewing with all of the changes and especially kind of knowing that we've got the surtax and we've got the 3.8% net investment income tax potentially being applicable to S corps and partnerships now as well, even if I actively participate. Really what you're kind of looking at is both current and future impact in each of these entity types. So the current benefit for having an S corp and a partnership are that there's only one layer of tax. So the entity itself isn't taxable. If the S corp earns $1 million, that million goes out to the shareholder level returns, and the tax is paid at the shareholder level. One layer of tax, and that usually is more efficient if you're in a business where you're taking the cash out every single year and you're not leaving a lot of cash in there for investments. The C Corp option, the current tax rate is 21%. I know we've got some changes in the brackets here, but the 21% is less than the individual rate. So at its face, it looks like a C Corp is the better option. The challenge with the C Corp is in order to get cash out of the business as a dividend outside of compensation, you pay tax again. So if you make $1 million inside of the C Corp, you pay tax at 21%. You've got $790,000 of cash still sitting in the C Corp after you pay your tax. If you take all 790 and issue a dividend to the shareholder, that 790 gets taxed again at 23.8% Fed plus your state rate. And so you're taking a 21% rate and you're now making it 42 to 50, somewhere in there. And so it really looking at, while in the short term, the C Corp looks good there, it's kind of what are you doing with this cash? When are you triggering that second layer of tax? And so if you're a newly established C Corp and you're in growth mode and you're using that cash to fund new operations and new facilities, and you're not going to trigger that second layer of tax for a while, and that C Corp looks pretty attractive. But you also have to give consideration on the back end if you were to go exit the business, because in an S Corp, in a partnership scenario, again, you only have that one layer of tax. In a C Corp scenario, if you can find a buyer who will buy purely stock, which if we have 1202 and we know as the shareholder that I'm not going to pay any tax if I sell stock, then maybe we've got a little bit more negotiating power. Because normally buying stock to a buyer is not what they want, because they don't get step up in basis, they don't get depreciation and amortization deductions like they would if they bought assets. So if a buyer comes in and buys assets in a C Corp, and then you take all of that cash out, you are triggering that double layer of tax in the year that you close. And so selling assets inside of a C Corp is a very tax inefficient manner. So that's that interplay where, what does it mean kind of currently, and what does it mean in the future if I have some sort of transaction? The next one is kind of looking at accounting methods, and this is all based on timing. All of these have to do with what we call timing differences. So things that hit your financial statement, either includable in income or deductible for your financial statement in a different year than for your tax return. And so that would be things like using the cash method of accounting for tax purposes only, whereas your financial statement is required to use accrual. And so some of those things can move income or deductions either into 2021 or push them back to 2022. Now, there's two types of accounting method changes. There's a non-automatic change, which is usually for some more complex ones. That has to be filed by December 31st of a given year in order for that change to be effective. The benefit of having an automatic change is you get until the extended due date of your tax return to make that change, and the impact will run through your 2021 return here. So if you do have an option to have an automatic change, you're going to know, you're going to have up until maybe September or October to see what Congress does with the plan. And so you might still have the opportunity up till those dates to say, okay, I don't want this income in 2022. I want to pull it into 2021 because I know in 22, I'm going to have the surtax, I'm going to have this net investment income tax if the Build Back Better plan gets passed. So reviewing some of those options and looking at timing is key. The other one, again, related to timing is accelerated depreciation. So when you're doing CapEx and you're buying equipment, over the last 10 to 15 years, the IRS has had some pretty heavy incentives that have basically let you write off everything on day one, outside of structural building stuff. So looking at whether or not you want to deduct all of that CapEx in 2021, or if you think your tax rate's going to go up, maybe there's an option to either delay putting that piece of equipment in service until 2022, or potentially opting out of bonus depreciation and electing to use makers, which would take the deduction over time, or even straight line. So again, just reviewing timing here. The other thing to consider is some of the state depreciation rules around this, because not all of the states conform to the federal rule. So you do want to be cognizant that you're also looking at state impact of CapEx and depreciation as well. And the last piece,
so on the one of the pieces that we're seeing that's creating some issues on the accelerated depreciation is it's really this whole supply chain piece. So typically, you may say, well, okay, if I need to reduce my income by 50,000 as an example, great. I'll walk down to the local dealership, I'll buy a truck, done. Well, you go down to that dealership now, they might not have anything. And that kind of applies to a a lot of pieces, whatever it is that you want. Equipment was an easy way for us to mitigate some taxes and, make that investment now as opposed to making it next year because we have a tax incentive. But with some of these supply chain issues, that's going to be a tougher and tougher option. So really it causes us to kind of come back to that, like that reviewing the accounting methods one. That's one that maybe we look at some of that stuff now that we traditionally haven't because we haven't needed to.
Oh, yeah. And the other big one on accelerated depreciation would be a cost segregation study. So in general, buildings get depreciated over 39 years. And so a lot of times when someone buys a new building, all of the cost ends up getting allocated to that building and depreciated over a very, very long period of time. So what a cost seg study does is it comes in and it looks at that building and it identifies certain types of expenditures that don't have to be 39-year property. That can be 5-year, 7-year, 15-year, and potentially eligible for bonus depreciation. And so a cost segregation study would have kind of an engineering team doing a site visit, looking at blueprints, walking through the building and saying, okay, here's the shell, here's the cost of everything, but this $100,000 is the parking lot. That should be a 15-year asset eligible for bonus. This hookup that was part of the building is specific to a piece of equipment or a machine. That should be a 7-year asset eligible for bonus. And the nice thing is that you can do it in a current year acquisition standpoint. So you bought a new building in 2021, you can do this cost segregation study to make sure you take advantage of those deductions. You can also go back and you can clean up on the fly in a given year without having to amend prior returns in most scenarios. Let's say you bought a building 5 years ago and you put it $5 million, 39 years, and you've been running that for the last 5 years. What you can go back and do is file an accounting method change form with the IRS and basically say that original $5 million building, it shouldn't have been all building. It should have been $4 million building and $1 million of eligible bonus assets. And basically in the year where you file that accounting method change, you get a deduction to true up and accelerate to where you should have been had you set it up right in the first place. So this is a nice opportunity, kind of a one-time pickup to get caught up for any building that you might have had. Some other things to think about too is just looking at compensation levels. Are we taking too much compensation out of an S Corp and we'd rather have some distributions coming out? If you're a C Corp, can we increase that compensation, pull cash out of the C Corp to avoid leaving the cash in there and having it subject to that second layer of dividend tax? The other thing too, just looking at retirement plan options. A lot of people might, maybe as the business grow, maybe they set up a very simple retirement plan, a safe harbor plan. And maybe the business is now more profitable and it could be something that might be a little bit more fancy that could weight some cash and put it in the owner's pockets and create some deferral there. So just reviewing your retirement options is a good thing every few years. The next one, and this was specific to COVID, and while this is the credit that I talked about in the infrastructure bill, they got rid of this credit effective for the fourth quarter of 2021. So going forward, not a lot of benefit here. But you can still go back and amend and claim this credit as well. And this credit was for taxpayers who either had a revenue reduction in 2020 or 21 over 2019. If it was 2020, the revenue reduction had to be 50% in 2020 quarter over the same quarter in 2019. For 2021, that went down to 20%. So you didn't need to have revenue drop off as much in 2021, or if you were shut down for a government order. Let's say you were in an industry and your state said, no, you cannot operate your facility anymore, you would also be eligible for this credit. And it's very, very lucrative if you qualify. For 2020, it's max credit of $5,000 per employee per quarter. And in 2021, they bumped it up to $7,000 per employee per quarter if you qualify. So we're talking about big dollars here. One of the only challenges outside of if you qualify is this interplay though with the Paycheck Protection Program, so PPP. And the IRS has basically said you can't use the same dollars of salary expense to support PPP forgiveness and claim an ERC. So what you kind of got to look at is making sure you're using some of those non-payroll costs as much as you can to support PPP forgiveness, because that will allow those payroll costs to be eligible for ERC. And so it's looking at things like rent and some of the other supplies and qualified expenses that were eligible for PPP forgiveness. Can we bump those up and allocate those wages to the ERC bucket instead of having to use them for forgiveness? A couple of the credits too. Go ahead, Brent.
Piece I'll just chime in quick on that is for any of our business or business owners that are listening, if you're going to take one piece from this presentation, it's the employee retention credit that Nick just talked about. I've done a ton of these, Nick, I'm sure you have as well. They really, I mean, when it's $7,000 per quarter per employee, those numbers can add up to be very, very large dollar amounts very quickly. So that, just to stress that, if there's one piece you're going to take away from this, look at that piece to see if you can qualify.
Yep. Yeah, I agree with that. We've seen some very, very large refunds coming for our clients, and they need it. Some of them had some rough couple of years, and so that extra incentives for some of these credits have allowed them to survive and a lot of times grow because they've had some of that capital to make investments to make sure they're continuing to pay their people. So I would agree with that one. I think that one is an opportunity still for a little while to go back. And if you haven't claimed it, look at 2020 and look at 2021. And if you can go back and amend, do it. A couple other things on the credit side. So the work opportunity tax credit is another nice one. So this is an incentive for hiring certain individuals in certain categories, whether that be long-term unemployed, veterans, some ex-felons, certain categories. And you've already made the decision to hire those people. And so this is, again, kind of free money. The challenge here is that you have to certify that employee within 28 days of hire. So you got to set it up with your HR department, with your onboarding department to make sure you're identifying those new hires that do qualify for this credit, and you're sending that certification form in. And that credit, again, it's tiered based on the type of employee, but can be up to $9,600 per employee. So that's another nice one to take advantage of. The research and experimentation tax credit, we talked about some of the mechanics and how they expanded it or how they're allowing you to continue to deduct. But you also get a tax credit for some of those activities. And research in the eyes of the IRS isn't necessarily lab coats, glasses, and microscopes. It can be any process improvement. It can be any product improvement that you're going through a scientific process for. So if you're a manufacturer, I would say almost 100% of manufacturers are doing some sort of level of research, because otherwise they're not developing new product, they're not growing, they're not doing anything more efficient, and they're not going to be around for much longer. And so I think this is one to look at and make sure that you're having conversations with your advisors, because I guess as you're doing the activities, it'd be nice to have this credit sitting there as well. State and local tax and transfer pricing, we won't spend a lot of time. I think state and local tax has been a little bit more front and center given the Wayfair case. The Wayfair case was specific to sales tax. And basically what it did is it got rid of the requirement for a business to have physical presence in a state to be subject to that state's sales tax. And so Wayfair was an online retailer, and they were located in one given state or a few given states physically, but they were shipping stuff all over the country. And the rules before were if you didn't have physical presence, you shipping product into a state didn't require you to collect sales tax. And so Wayfair and Amazon had been doing that for a while. People were buying things without any sales tax being paid. And so what Wayfair did is instead of looking at physical presence, it looks at the dollar of revenue shipped into a state or a number of transactions shipped into a state. And so you may have nexus now in a state that you've never historically had a nexus in and be required to collect and remit sales tax from your customers. And if you're not on top of that, while the liability is really your customer's liability, they're the ones that should be paying that sales tax, because your company's acting as an agent of the state can come in and assess and collect all of the sales tax that you should have collected from your customers from you. And then your options are going back to your customers and saying, oh, hey, remember that thing that I sold you a while back? I need some more money because now I got to pay the sales tax on it. And so I think this is something that, even the manufacturing space where most of your clients might have some sort of exemption, still reviewing this, making sure you're collecting your exemption certificates. And if you don't have exemption certificates, making sure you're collecting that sales tax and not taking something that is your customer's liability and making it yours. And then the transfer pricing piece, that's more on the international side. Given some of the tax rate increases that could be coming in the US, can we revisit that and maybe see, are we reporting the right amount of profit in the US, or do we have some options to put that profit somewhere else? And I know that was a lot, but that is all the content that we had. So Megan, I don't know if there were any questions in the chat or anyone had anything we could stick around to answer them.
Yeah, we have time for a couple questions here. So can you discuss how depreciation elections create flexible tax planning strategies?
Yeah, Brad, I could take that one. So we talked about it a little bit. The IRS has bonus depreciation and options where basically most property that isn't a structural building can be depreciated on year one. And so the question is, do you want to depreciate it all on year one? Where do you want that deduction to fall? Because while that's the default, you have options to opt out of that bonus depreciation and spread the deduction over 5 years, 7 years, whatever the life of the asset is. So if you thought your tax rate today was going to be higher than your tax rate tomorrow, then I think taking bonus depreciation makes sense. You're getting a deduction at a higher rate, you're getting a bigger bang for your buck. But if the Build Back Better plan goes into effect and that's going to increase your tax rate in 2022, then maybe we don't want all that deduction in 2021. So in that case, maybe we opt out of bonus depreciation. The downside is we've got to pay a little bit more tax currently, and there's some time value money considerations. But if the rate increase in 22, 23, the years where we're going to take the expense is high enough, then we're okay having that time value money cost because we know we have a permanent rate arbitrage in the future.
Yeah, the other part that I'd add that's a little bit nice with this is you don't have to make that decision by the end of the year, right? So when we're in a situation like now that we don't know what the tax rates are going to be exactly next year, we really have until we file the tax return. So that's really for most businesses, that would be next fall. We have until next fall and as far out as possible of when we'd have to make that decision. So we can punt a little bit and kind of hope, because I think I said the exact same things last year, thinking that we'd have legislation by now. But hopefully by then we'll know what the structure looks like to help navigate some of those uncertainties.
All right, thank you. Looks like we have kind of a quiet group today. I'll give everyone a minute here to get in some last minute questions.
You've got our contact info on the slide there. If you guys have questions, feel free to reach out to Brad or I directly.
All right, I'm not seeing any questions coming in. So yeah, thank you so much, Nick and Brad. As they mentioned, feel free to reach out to them with any specific questions you might have. Otherwise, do you guys have any last minute comments before we close things out?
Thanks for letting Nick and I come and speak, and I really appreciate the opportunity to talk to you guys.
Yeah, and I'm sure if anything passes, you'll see it front and center on CNN or somewhere. Again, hopefully they give us some time to react to it, but it's not looking likely.
Awesome, thank you so much, guys. For everyone else, we're continuing to add webinars, so make sure you're paying attention to the upcoming webinars calendar, and that is ifai.com/events is where we post all of those. Otherwise, as we close out, you guys will see a very brief survey when you exit, and we would really appreciate it if you took a minute to fill that out. Otherwise, thank you so much, everyone, for attending, and have a good day.
Thanks, everyone.
Thank you.